with increased taxation, more inflation, interest rate uncertainty. These are not healthy signs for any economy. Hi everyone, welcome to today's video. So recently there were some very important changes that were made on the Finance Bill 2023. This will create a lot of impact on your investment, especially if you are investing your money in debt mutual funds. So let me break down this very important topic in very easy to understand language, especially for beginners. That's one. Second key thing is what is the larger implication and macro aspects to this change, and where is it the investing world is going in India. This is a part that no one is explaining, so I will talk about that. And finally, what is it that you and I as normal retail investors should be doing? So this is the precise piece of conversation I'm going to have with you. So let's kickstart, and first and foremost take a look at this particular snippet. This outlines some of the key amendments that have been made to the finance bill. So the first key amendment is regarding the mutual funds, and you can see that the mutual funds having less than 35% AUM in domestic equity to lose indexation benefits. I will explain this in a minute, but let me also take you to point number 6, right? And this is a very interesting point, that securities transaction tax on the sale of options has been increased to 2100 crore turnover, this. So all this has been written. So point number 6, if you don't understand futures and options much, in simple words, it is saying that STT has gone up in terms of option selling. Now this creates further pressure on FNO traders and especially the trading community. Already trading is a profession where people do not make very healthy returns. These are not my words. These are the words of Nitin Kamath and Nikhil Kamath, who are the co-founders of Zerodha. And they have said that 99% of traders do not even beat fixed deposit return. And on top of that, if more taxation is introduced for traders, this becomes a very complicated point. Now you will say, okay, mujhe kya farak padta hai? I'm not a trader. So okay, let's move to point number 1 and let me break it down. What exactly does it mean? So okay, so let me break down this specific point in very easy to understand language. So let's assume that you invest 1 lakh rupee in mutual funds. What type of mutual fund? Debt mutual fund. So what is the meaning of debt mutual fund? So basically there can be two categorizations that can be done. One is called as equity mutual fund and one is called as debt mutual fund. So for example, when you're going and paying, let's say 10,000 rupees to your mutual fund manager, and if they are picking up that money that they are going and buying ITC, HDFC Bank stock, Pidilite stock, vagera. So that is called as equity mutual fund. What is the meaning of debt mutual fund? So debt mutual fund simply means that these are bonds. So what is a bond? So I had already made a video a couple of days back. I will link it in the description box. You can go and watch it in case you're not aware of what bond is. But one of the prime examples of bond would be something like government securities or even fixed deposit. So that is a type of a bond. What happens in a fixed deposit? That you go to your bank and say that, you know what, here is like my 10,000 rupees. I want to do a fixed deposit of 3 years, and bank will tell you that, okay, great, we are going to pay you right now 7.5% interest rate. So what is going to happen after 3 years? This 10,000 rupee is going to grow at a CAGR of 7.5%, and you will get that money back after 3 years. So in very simple words, a bond is a promise that could be made by a bank, that could be made by government organizations, or there could be corporate bonds also. So please watch my video in case you don't understand what bonds are. I have explained it in more detail. So back to the change or the amendment that has happened. So let's assume that you are investing 1 lakh rupee in mutual funds. What type? Debt mutual funds. So up until now, the rule simply said that if you are investing your money in debt mutual funds, and if you hold that mutual fund for 3 years or more, then you get indexation benefits. And what is indexation benefits? I'll explain that. And after applying the indexation benefits, you will have to pay 20% taxes. So I know that many of you might not have gotten this point. So let me break it down with an example. So let's say that you invest 1 lakh rupees, right? And your growth on mutual fund is, let's say, a CAGR of 10%. So for the ease of simplicity, let's assume that 1 lakh rupee after 3 years, it becomes how much? So it becomes 1.3 lakhs. So what is the total benefit or total profit you have made? You have made 30,000 rupees as your total profit. And what is the growth rate that we are assuming here? So we are assuming 10% as the growth rate. Now indexation simply means that what is the rate of inflation, or what is the average rate of inflation over the last 3 years. So in India, it will come out to be roughly, let's say 6 to 7%. And what is the rate at which your money has grown? It has gone at 10%. So if you assume 7% and offset it, then so 10% minus 7%, that becomes 3%. So this is the growth rate that we would assume. So in year 1, and again, we are just simplifying here. So in year 1, it will become 1.03, then 1.06 and 1.09. Yes, I have not included compounding just to explain you the math. So यहाँ पे your total profit becomes how much? 9,000. Now on this, you had to pay like 20% tax. So now what has happened is that the indexation benefit benefit has been taken away. So now, to cut the long story short, that taxation on debt mutual fund has gone up quite a lot. So now the government was asked that, okay, आपने ऐसा क्यों किया, लोगों की इतनी बुरी हालत चल रही है and you are taxing them more. So why? Explain the rationale. So basically, this is one of the narrative that they have presented. Again, let me explain that. So their point is that, see, you guys do fixed deposits also, right? That for example, you are depositing 1 lakh rupees. Then in 3 years, if we assume 10% growth rate, so total 30 मान लेते हैं, क्या अगर वैगर छोड़ते हैं, simple interest. So simple growth rate. Then in 3 years, it becomes 1.3 lakh. So your profit is 30k, right? So same as before. Now FDs are taxed as per the income slab that you are in, that this 30k will be considered as a gain or a capital gains, and if you are in that 30% tax bucket, then you will have to pay 9,000 as taxes. So this kind of levels the playing field between fixed deposits and debt mutual funds. So this is the statement that is coming out from the government. Now you tell me whether this is sensible, this is not sensible. I will just quickly present my analysis, and I'm not trying to criticize the finance ministry, finance minister, government, etc, etc. I'm just simply trying to present the viewpoint here. So let me very quickly help you understand the difference between fixed deposit investments and debt mutual fund investments. See, when you are investing in fixed deposit, you are inherently taking slightly lesser risk, because in debt mutual funds, depending on the type of debt that you are buying or getting your money invested into, it could be corporate debt, so the risk is higher. So therefore the reward also should be higher for people to continue to invest in debt mutual funds. So this is like simple principle of investing, that for every unit of risk that you are taking, you should be compensated adequately enough. So this is point one that you should understand. Second key point is that, see, when you are investing your money in debt mutual funds, there could be loss of principal. So the entire crisis of Silicon Valley Bank happened because there was loss of principal on their government bond, so to say, which was a 30-year held till maturity bond. What happens in debt mutual fund is that sometimes there are like 10-year bonds or 30-year bonds. You buy them, let's say in the year 2023, they are maturing in the year 2033. Then in 2025, your wedding is coming up. You will say, yaar, पैसे चाहिए, हाई फाई वेडिंग करनी है, प्री वेडिंग शूट कराना है, पोस्ट वेडिंग शूट कराना है, वगैरह वगैरह शूट कराने हैं. सो यू नीड अ लॉट ऑफ मनी. सो इन 2025 यू डिसाइड कि अच्छा, आई हैड परचेज लाइक सम डेट म्यूचुअल फंड, आई विल लिक्विडेट देम. सो व्हाट इज द मीनिंग ऑफ लिक्विडेशन? लिक्विडेशन मीन्स दैट you want to sell them off. So the point is that in the secondary market means that if you have purchased a security the way Silicon Valley Bank did, which was a 30-year held till maturity security, and let's say that at the point of getting maturity after 30 years it was at 100 rupees, right? But since Silicon Valley Bank had to sell them off in the market earlier because they needed money, they only sold it at 70 rupees. So there was loss of principal that happened. So something similar can also happen with debt mutual fund. And finally, because the government's perspective was कि we want to level the playing field for FD and debt mutual funds. So therefore withdrawal of incentive for debt mutual fund. भाई आपको level playing field करनी है, that you give tax benefits here also, no? Leave some room for retail investors and small players. Let them also make a little bit of money. So to cut the long story short, to me it does not make a lot of sense why FDs should be treated exactly like debt mutual fund, because inherent risk in debt mutual fund is higher. Now you only tell me that, now would you want to park your money in debt funds, or would you rather want to park your money in fixed deposits? I will simply go and put my money in fixed deposits. I would put zero money in debt mutual funds. And finally, one more point you need to keep in mind, that when you are doing fixed deposit, the bank, does it charge you like some commission, expense ratio, all this stuff? No, वो दूसरी तरीके से charge करते हैं. That's a separate conversation altogether. But the debt mutual fund manager, go and take a look at the expense ratio that they charge. So all these commissions, charges, now taxation benefits also going away. I highly doubt it that a lot of people will get excited about debt mutual fund investing space. So now comes part 2, and I will explain you from a macroeconomics point of view why this is really being done. And please like the video, because these type of videos will get to more people with your like and little bit of support, and will make them more financially aware. I put a lot of work in terms of researching, and to be honest, I'm a single person team. None of my work is outsourced in terms of having big teams, making them research. I sit and study every single point. So I study more than IIT aspirants every day. So for me, marks are like likes and comments that you guys give. So yeah, so a like will be deeply appreciated. So anyways, coming back to the point, and there are 3 graphics that I would like to show. So the first graphic is the debt graphic, right? So debt simply means कि दुनिया में कितनी उधारी चल रही है, and how much loan the governments and everyone has taken. For example, this is the private debt and this is the public debt, right? So you can see that the rate at which the debt has gone up has been quite massive. There has been an explosion of debt in the world right from 1970s onwards. This was like 100 units. Now we are sitting at 256 units. So yeah, this is like crazy amount of debt that is there. Now, when someone takes debt, what needs to happen? You have to repay the interest, right? So that is a simple point of taking debt. Now, debt is of multiple types. For example, you can take a short-term loan कि आपने एक दिन के लिए credit card loan लिया. Second could be that you take a very long home loan, 30 years. It could be 20 years. It could be 5 years. It could be 10 years. So the debt has different maturity. It matures from like literally one day all the way to even 100 years and beyond. So this brings us to the concept of repayment of debt. Now, as the interest rates in the world increase, which have been increasing, again, please go and check the interest rates in the US, and I'll put the snippet here. You can see that there has been a very sharp rise in the interest rates in the world. So if you put 1 and 2 together, what is it that you can draw? You can easily figure out that, you know what, सरकार की बहुत debt हो चुकी है, and the rate of interest have also gone up. So the repayment from that side is going to go up. So in simple words, the EMI, in a way that the government has to pay back in terms of the borrowings that they have taken, that goes up. And this is what is scaring the government. So now comes the natural question that what is going to be the implication of these changes, and is there like some macro horizon that we can look at? So there are 4 specific implications that I see right off the bat. So first and foremost, the debt market was maturing in India at a very fast rate because there were incentives to invest in debt. So that incentive has been taken away. So the maturity of the debt market gets delayed. Now what is the meaning of this? Because I have thrown a lot of finance here. So see, there is equity market and there is debt market. Now in the US, if you go, the size of the debt market is very, very big. The size of equity market is not that big. In India, somewhat similar was going to happen because we need a very thriving debt market that is good for the capital markets. So something similar was happening. But with this move, the maturity of debt market is going to stagnate a little bit. So this is point 1. Point 2 is that there is going to be outflow from the debt market, and this is directly going to help something like real estate market, which has been lagging in India. I had been buying a lot of real estate and I had categorically pointed out, I give a lot of commentary on my stock market course also regarding real estate, and also on the member community tab of YouTube regarding buying real estate. I've been investing quite aggressively. So as long as the inflation in the world remains fairly high, and second, the interest rates in the world become very high, so you will first get very good real estate deals if you are able to scout them really well. And second is that in a high inflation environment, the cash flow assets, for example, आप घर खरीद के डाल दो, and if you are able to rent it out, you'll be able to make a cash flow. So these cash flow assets become really prominent. So therefore, I have been investing quite aggressively for the last several months in real estate. I have purchased some new real estate also, and I will take the community through it. This is one of the sectors that I'm extremely bullish on for the next 5 years. If the incentives for investing in debt mutual funds is withdrawn, then the money will flow to alternate asset class like real estate, gold, वगैरह वगैरह. So this is definitely going to happen, and even in equities, there will be more investment compared to debt. Third key thing is regarding taxation, and आप लिख के ले लो कि taxations are not going to go down anytime soon. 2 decades, just wait for 2 decades, right? People will be doing try when it comes to taxation. You will say that, okay, people are doing try now also about taxation. No, wait and watch. 2 decades everywhere where the government can make money, they will make money. And again, I'm not trying to criticize the current government. Please don't make it like political. I'm least bothered about politics. This is generally what is happening around the world, that taxation structures are going up. In India also very similar is happening. Problem in India is that the return on taxation is very, very low because the social advantages are very few. People are okay paying taxes. That's not an issue. But if you are getting free healthcare, free education, all that stuff, then it makes sense to pay such high taxes. But right now, that structure is somewhat in an imbalance, and this debt mutual fund taxation game and also additional taxation on futures and options, it just highlights it negatively and it creates a bad sentiment for the capital markets. Fourth and finally, see, when any economy is trying to become the leading economy in the world, it needs to have fairly stable capital markets. India is doing fairly well, but investors get spooked when such changes are introduced at a very fast pace, and कल को tax लगा दिया debt fund पे, after 1 year more taxation on something else. So people cannot plan things out. So this becomes a problem. So big investors wait and watch, and it just generally dissuades them from investing. So final part, what is it that you and I should be doing as retail investors? Number 1, please understand that making returns in the future is going to become harder and harder. That's how it is. With increased taxation, more inflation, interest rate uncertainty, these are not healthy signs for any economy, including India, and this is a worldwide problem. Not criticizing India on this, but making real returns is going to be harder. Point number 2, as I keep saying, please be a diversified investor. One of the best things that has happened to me is that I picked up diversified investing style, and please go and check my videos that I invest my money in a highly diversified manner. So that has really benefited me in terms of dealing with this highly volatile investment environment and highly uncertain investment environment. So I would encourage all of you to adopt a diversified investment style where you learn about different asset class and do not become a maximalist. कि भाई हम तो debt में ही करेंगे, yeah, we'll only do like stocks, we'll only do like real estate. No, please learn the good and bad aspects of everything and invest your money accordingly by splitting it. Point number 2 is regarding taxation. There are legitimate ways of saving taxes. Please learn about them. Very, very important. Please do not miss out in terms of claiming your 80C, 80D and other additional benefits that you get. A lot of people are lazy, including me. So going forward, tax optimization is going to become critical. So please learn about it. I'll put some links in the comment and description box. You can learn more about taxation from them. And more specifically, I will write some community specific posts on saving taxations also. So please learn how to optimize taxes. Final point, that going forward, it becomes very important for you to understand how to pick equities correctly in a correct, right fashion. Because if making returns from FD, if making returns from debt mutual funds or generally through mutual fund is going to become harder, then you have to learn direct equity picking. I run a course. If you like it, definitely consider joining it. We have created an investment community around it where people interact, learn from each other. I also do seminars. I also do live classes to clear the doubts. So if you want to take your understanding about direct stock picking to the next level, you could consider checking it out. Thank you so much for watching this video, and I will see you soon.